Today I'm going to share some very cool empirical findings with you based on a recent finance research paper written by Vitaly Meursault and his co-authors at Carnegie Mellon University and University of Pittsburgh. The paper is called PEAD.txt, Post-Earnings Announcement Drift Using Text. And in this paper, Vitaly and his co-authors show that if you know a bit of machine learning, well, maybe more than just a bit, you may be able to earn superior investment returns over a 12-month period by simply waiting for companies to announce their earnings and then investing in the stocks of those companies that provide a positive earnings surprise. Now, to fully understand their research, I need to provide you some background information. So prior research, dating as back as 1968, has shown that when companies provide a positive earnings surprise, meaning when their quarterly earnings come out to be more than what analysts or investors were expecting, their stock price typically not only jumps on the day of the announcement, but also continues to increase over the next several months. And similarly, when companies provide a negative earnings surprise, their stock price not only drops on the day of the announcement, but continues to drift downwards over the next several months. In finance, this empirical finding is commonly referred to as post-earnings announcement drift, or PEAD. PEAD suggests a very simple trading strategy. Wait for companies to announce their earnings, compare the earnings number with what analysts or traders were expecting, and simply buy the stocks of those companies that provide a large positive earnings surprise on the day of the announcement. Guaranteed abnormal returns over the next several months. It's so simple, your grandma can do it, let alone sophisticated investors who are always on the lookout for sure shot returns. And it seems like over the years, this is exactly what has happened. More recent research shows that buying the stocks of companies with large positive earnings surprises is not nearly as profitable as it used to be. It seems that on the day of the earnings announcement, investors are quick to identify stocks of companies with large positive earnings surprises and rush to buy them. As a result, the stock price increases to the point where subsequent returns are not nearly as predictable. In other words, over time, the post-earnings announcement drift seems to have drifted away. Or has it? In their paper, Vitaly and his co-authors show that the drift is still there, but you need to think a little bit differently about what constitutes an earnings surprise and how to measure it. Rather than comparing a company's announced earnings with what analysts or investors are expecting at the time, which is what most prior research has done, the authors essentially say, let's deduce earnings surprises by analyzing the content of the company's earnings calls. For those of you who don't know, an earnings call is a conference call that the management of a public company holds soon after it publishes its earnings report. It is often well attended by analysts, investors, and members of the media, and in it, the management discusses its financial results and the future outlook of the company in a considerable amount of detail. The approach that Vitaly and his co-authors take towards measuring a company's earnings surprise is quite interesting. They basically say, look, if a company's stock price goes up on the day it announces its earnings, it must be because the management conveyed some new positive information to the investors in the earnings call. So rather than looking at just one earnings number, how about we develop an algorithm that goes through the text of the earnings call and identifies the content, the text that causes those abnormal returns. The intuition is a rather simple one. If there is certain content in the earnings call that predicts abnormal returns on the day of the earnings announcement, then it must be that that text reflects unexpected information, or the surprise. And once we know what kind of text is indicative of an earnings surprise, we can then look for that kind of text in companies' earnings calls, identify companies which are providing a large positive or negative earnings surprise, and then examine whether their stock prices drift after an earnings announcement or not. It's pretty neat, isn't it? And so that is exactly what the authors do. They develop a machine learning model and first train it using previous 8 quarters worth of announcement returns and earnings call texts to identify words and phrases that indicate new information. And then they see which firms are using the same words and phrases in their earnings calls today. This way, in each quarter, they are able to rank firms from highest to lowest based on the magnitude of earnings surprise. And after doing this at the end of each quarter between 2010 and 2019, the authors then track the performance of these companies over the next 12 months. And their main question is simple. Do companies with large positive earnings surprise continue to experience an increase in their stock price? And likewise, do companies with the largest negative earnings surprise continue to experience a decrease in their stock price? And their answer is yes. Yes, they do. Specifically, in their sample, they find that if on the day of the earnings announcement, you bought the stocks of top 25% of the companies whose earnings calls provided the most positive surprise, and simultaneously shorted or sold the bottom 25% of the companies whose earnings calls provided the most negative surprise, you'd make a cumulative abnormal or excess return of 2.87% over the next 1 quarter, 4.61% over the next 6 months, 6.51% over the next 9 months, and about 8% over the next 1 year. And perhaps more importantly, what they also show is that these returns are considerably more than the ones you would have made had you instead tried to identify companies with the large positive or earnings surprises in the more traditional way, where you compare their announced earnings number with their expected earnings number. All right, so what does this all mean for you? Well, if you are an investor in a specific company, it looks like you might want to attend their next earnings call, because the paper suggests that they contain valuable information about the firm and its underlying economic activities, perhaps more so than the earnings number just by itself. But if you're like most investors who just care about making money and not the company per se, perhaps it's time to consider taking a class in machine learning or hiring someone who knows it well. As the authors note in the paper themselves, our paper shows that this comprehensive AI ensemble model outperforms human analysts and potentially identifies a valuable avenue for future AI analysts to process textual data and improve prediction tasks on future earnings and stock prices. All in all, I thought it was a pretty cool paper with a very unique approach towards measuring earnings surprise. If you'd like to read the paper yourself or learn more about the authors, links in the description below. Check them out. This is Professor Ikram. Thanks for tuning in. If you found this video useful, click the like button and subscribe to the channel. And feel free to ask any questions using the comment section. Happy learning.